Hello, everyone. My name's Diane Donnelly, and I am with the Donnelly Group of Keller Williams Flagship of Maryland, and I run a small team here in Annapolis. And we've been doing some webinars about real estate and things otherwise. But today we have Emily Hickox talking with us, and Emily is a spokesperson for the Consumer Credit Counseling Services of Maryland. And today we're going to talk about the 5 factors that contribute to your credit score. And we're going to get into why it's so important to understand what your credit score is and take different steps to be sure that you get your credit score up as high as you can. So Emily, tell us a little bit about yourself and about CCCSMD.
Sure. Thanks, Diane. And thanks for having me participate in this again. I really enjoyed our last talk, and I know this one will be just as fun.
Yes.
So I am a spokesperson, and I'm just very passionate about financial education and helping people understand their personal situation. And that's what CCCSMD does. We're a nonprofit housing and credit counseling agency, and our mission is to help people improve or restore their financial health. We do that by using our financial advocates. They're a team of folks that help each client understand their goals and concerns about their financial situation, and then help them develop action plans to improve, to make their life where they want it to be. And the credit score is part of that. We take a very holistic approach to helping our clients. We help them with creating a budget, whether that's just an everyday budget or a crisis budget like we've talked about before. We help them with managing their debt, paying off if they've gotten behind on some payments, helping them catch up on that and how to manage a total payoff plan. And we help them with lots of different kinds of debt. It may be mortgage, car loans, student debt, medical bills, so lots of different areas. And the other thing that we do is help individuals understand their credit report and what's in it and how it's contributing to their credit score. So that's why I'm excited to talk to you about this today, because it's definitely one of our bigger services.
Excellent. And how much is the service for you, for somebody to walk in to see you to do some of these counseling sessions? What would that cost?
Lots of different areas. The majority of our services are free, but when it comes to the credit report review, which I'm going to talk about throughout this meeting, that does come with a fee. And that's $40 for an individual or $60 for a couple. And that service does include pulling the credit report and doing a lot of analysis of it.
So that's $40 for the whole training, the whole review and everything.
Yes, it is.
That's a small price to pay, because what we're going to learn and we're going to talk about today is that it's not just mortgage companies that pull credit reports to establish what your interest rate will be, but insurance companies do it, and there's lots of other companies. So you'll find very quickly that $40 to increase and to better your credit score is a small price to pay. But let's start at a really basic level, Emily. Everybody knows what a credit score is, but what is a credit score?
It's true. Everybody knows what it is, but then when you ask them to explain it, they're like, a number. And that's okay. That's why people like us are here, to help explain it and why it is important, but also why you shouldn't obsess about it. And I want to talk a little bit about the balance of that. So the credit score is just a 3-digit number that determines your credit worthiness. I love that word because that really sums up exactly what it is. It's telling other people how worthy you are of getting credit extended to you. So it's on a range. It ranges from 300 to 850. That range has changed over time, but that's what it's currently at. And the score is divided into different categories. So generally, anything above a 700 is considered good. Anything above an 800 is considered excellent. So it's when your credit score is below a 700, doesn't necessarily mean it's terrible and the world is going to end. It just means that there's room for improvement. So below 700 is divided into, and the line changes depending on where you look, but fair and poor and bad. So I think it's
and to give you the audience an idea or a benchmark, if they were looking to buy a home, FHA, Federal Housing Administration, their objective is a 620 or higher. And of course, that depends on the lenders. Lenders can change it and have risk overlays. So some companies say, if you want to have an FHA loan and be with this mortgage company, it's a 640 minimum credit score. So that gives you an idea. So if we range from 300 up to 850, and at 620 or 640, you can get a loan to buy a home. So that's just to give people a benchmark or something to shoot for. And we touched on this, but why is credit scores so important in your credit worthiness or your credit history or your credit profile? Why is it so important?
So the reason it's so important is because if you're like most people, you're going to want to make larger purchases than you have cash on hand for. Now, of course, I always recommend buy things that you have cash for, but very few people can outright buy a home. That's one of the largest purchases that people will buy and use debt to get it in the form of a mortgage. So if you have the hopes of buying a home, you want to make sure that your credit score is good, or good to excellent. I have heard 650 a lot as a number for certain companies to give lending. It will help you get higher limits on other types of debt, such as credit cards. You will get higher limits the higher your credit score goes. But even a car, if you want to buy a car and you can't pay for it outright in cash, the car loan terms are going to depend on your credit score, and not just the interest rate, but how much they're willing to lend you in general.
Right. So it's a snapshot. And I want to emphasize, and you touched on this a little bit too, that you are not your credit score. So because your credit score is lower than you wanted or lower than you anticipated, that doesn't make you. It just says, here's a snapshot of what's going on in your life at that time, and there's room for improvement. So don't ever stop seeking help because you're embarrassed of a credit score. Right?
Absolutely. Absolutely. That's so important. And there's been so many folks that I've met throughout my journey that have started with very low credit scores, in the 300 to 400 range, and have worked over time to build that back up into the 600 to 700 range. And it does take time, and it takes patience and a lot of discipline, but it's worth it because more doors are open to you once you have that higher credit score. I heard a joke a little bit ago. I was talking to somebody about the credit scores, and I've got a few people in my life that try to, boast their credit scores. There's a little bit of competition going on, and I don't really ever say mine out loud. So I just listened to all this, and someone said, I think they should start having credit scores on your dating apps.
On your dating apps. That would meet some people out, wouldn't it?
Yeah, it really would. And I mean, part of me says, well, that might be a good idea, but it's really a terrible idea because you don't know what's happened in people's life and their circumstances. One thing that can impact your score is, it obviously a lot is based on the debt you've already had. Now, if you were in a life situation where you were co-signing and you had loans with other people and those other people defaulted and there was a problem with the folks you were co-signing with, that could ultimately have an effect on you too. So we definitely shouldn't be dating people based on their credit score. But if you find out they have a low one, tell them to call us.
Good tip. Good tip. Now, who looks at the credit scores? We obviously know when you go to buy a home, people are going to pull your credit score. And there's no sense in pretending that your credit score is higher. Sometimes we'll sit with people and say, how is your credit? And they'll say great. And we'll say excellent. And we go to pull it. It's not great. So great is different for different people, but it doesn't make sense to pretend that your credit score is more than it is because they're going to pull the credit report. So outside of mortgage companies looking for their credit scores, who else pulls credit?
There is a lot of folks pulling credit right now. I think part of that is because it's easy. It's an easy way to get a snapshot of how this person is going to handle their finances. And that's important to a lot of companies. It's important to insurance companies, even cell phone companies in some cases are looking for the credit score. If you're, because a lot of the phones you buy now, you're not outright buying a phone, you're buying it on a payment plan. So how likely are you going to be able to keep up with that payment plan? Employers use it as well, especially in industries where you may need to have a clearance, a secret clearance, or something that is going to have you handling money or a high level of security items. It's one way to see how do you handle your own finances. So you'll see employers pull it. And not just with mortgages, but when it comes to housing landlords, if you're looking to rent, they're using it quite a bit. And it's a very easy way for them to say, is this person going to be able to keep up with the mortgage payments? Because one of the things the credit score is comprised of is how much debt do you have? How high are your balances compared to your available credit? And it's a very small window into how extended is this person and will they be able to pay us every month?
Yeah, good points. What are the consequences of low credit scores?
The biggest consequence is that you're not going to have the opportunities that you likely want. And in the biggest areas being housing, whether it's a mortgage or renting, and in transportation. So most of us want to have our own car in our society. And in order to get that, many folks have to finance it. So housing and transportation are the biggest areas where you'll feel the hit. You might be able to get loans depending on where you are in that low range, but the terms are going to be very unfavorable. So that's what's really important to know, that, okay, you may have that 620 to get the mortgage, but we're not going to give you the 3% rate everybody else is getting. We're going to give you 5.5.
Yeah.
So that's where it's really important, is what exactly are the terms going to be?
Right. So your life is more expensive if you have less than stellar credit compared with your neighbor who does have great credit, because your risk is higher. You're considered a higher risk to give money to than the neighbor who has shown a history of paying.
Yes.
So your life is basically more expensive.
You are more expensive. You're also likely more stressed out. And I've talked about that with you before, that there's a very large emotional side to finances that people need to acknowledge and talk about. If you have a low credit score and something serious happens in your family and somebody needs money or loans for medical bills, whatever it might be, if you have a very low credit score, you can't just go out and get a personal loan. You can't just go out and get a new line of credit. It might be very hard to do that. And even if you can, again, the terms can be unfavorable and you end up paying a lot more than you would have. I always encourage people to have an emergency fund for things like that. But truthfully, in our world, that's not always possible, especially when we have medical costs as high as we do here.
Yeah. Well, one of the main questions that we had today is, what are the 5 factors that contribute to a credit score?
I love this question. And I was telling you recently that I had this conversation with some family lately, because it's really important to know what goes into it, so then you can decide, if you've never had debt before, if you've never had credit, is this worth getting into debt to have a good credit score? And then also, it's important to know what factors you can manipulate, that you can influence right now. So I'll break it down for you, kind of go through each one, but just stop me at any time.
Okay.
Okay, so the first one, the largest contributor, is your payment history. And that's going to be 35% of your score. And that sounds like a lot, and it is. And for folks that have had some issues with keeping up with payments, you might be feeling like, oh no, this is terrible for me. But this is a great thing. It's a great thing, because payment history is the one thing you can influence right now. It's the one thing that you can change today very easily. So all it takes is keeping up with your minimum payments. They're looking at the way the companies look at it is, are you making your payments on time? They're not saying, are you paying more than the minimum? They're not saying, how much over the minimum did you pay? There's no one looking at that. It's just, did you make the payment? So if you have a credit card bill that this month has a minimum payment of $50, but an outstanding balance of $1,000, paying the minimum payment of $50 still contributes to good payment history. So you want to make sure that even through crises, in good times, you always want to be at least paying the minimum, because that credit history has, the payment history, has a huge impact on your score. One of the things I suggest is always looking at the due dates, and really understanding your loans and when your bills are coming due, and creating a plan. Ideally it's in a full budget, but some sort of plan that reminds you to pay your bills on time, because that is going to have a big impact. So maybe you have an app that can list all of the payments for you, or just setting up a calendar reminder in your phone that, hey, my Visa bill is due this week. I've got to get that in. Ideally, you can set up minimum payment automatic payments. So that's always a good feature for folks to use. That really helps ensure that your payment history looks really good. And
Great.
you can always go in and make more if you want to, but it at least locks in that minimum.
Okay, excellent. What's number 2?
So number 2 is the amounts owed, and that's 30%. So amounts owed isn't just looking at a blanket number of how much money do you owe on your credit cards or on your mortgage. It's looking at a ratio. So it's looking at how much do you owe versus how much do you have available on your credit. So for example, if you have a credit card that has a balance of $20,000 or an available balance of $20,000, and you're only using $1,000 of that, that's good. That's a very low ratio. But if you're using $19,000 of that, that's very high. And that's gonna tell a lender that, hey, they might be close to overextending themselves. So that's why that has such a big contribution to your credit score, because that ratio is what helps the lenders understand, are you overextended? Because if you're a lender, you don't want to give a loan to somebody that is already in danger of keeping up on the debt that they have.
Yeah. So if somebody had to make a choice of making minimum payment or trying to get that ratio down so they pay more to that high balance credit card, I think what you just said is make sure you pay your minimum on the other credit card or the other line of credit, whatever credit that is. Don't miss that just to pay down your higher interest rate card or the higher balance card. Right?
Absolutely. Yeah. Don't sacrifice keeping your payment history in good standing. Keep it all at minimum payments. A good rule of thumb is to try to stay at half of your available balance. So in the case of that $20,000 credit card, try to stay at half that amount. So you'd be, $10,000 or less, and you're probably in fairly good shape when it comes to that ratio.
Okay. Good tip. What's number 3?
Number 3 is length of credit history. So this is one of my favorite ones to talk about, because I remember being, 18 and walking on a college campus, and this guy trying to sell me a Visa card and saying, you need this, you need it because you're an adult now. Mm-hmm. And if you don't start having debt as an adult today, then 20 years from now, when you try to get a house, or 10 years from now, you're not going to be able to do it because you don't have long enough credit history. And I fell for it, and I got a credit card. I still have it locked away somewhere. The only one I still have hidden somewhere. But they were very wrong, because the length of credit history only contributes to 15% of your credit score. So while, yes, the longer you have history of having debt and being in good standing with that debt, the better your credit score may be. But it's not a big enough contributor to worry about, walking out, of your house for the first time to go to college and opening a credit card.
And I'll tell you, on the flip side of that, what we've run into sometimes is people trying to get their credit scores up a little bit. And you talk to them, you're not quite there, you're just about there, you're getting there. And they call you back, I've got great news, I closed all of my accounts, my credit score is going to shoot up. And you're like, you didn't, don't tell me you closed your accounts, because if you do have that history and then you close it, you're closing out your good history. So these numbers aren't going to count for you anymore. So what do you say to that, Emily?
Yeah, that's a great point. So a couple of more things on the length of credit history. It matters if the length is on the same debt. So if you have a mortgage for 30 years and you've been paying that mortgage very regularly, that's an increase to your credit score. That's a positive for your credit score. But if you have 7 different credit accounts and you're opening them and then closing them, and you only have one for a year and then you have one for 3 years, that's not going to have a good impact. The goal is to have steady credit. And so when you are done with a credit card, which I hope everybody gets there, that they, create their own debt snowball, whatever it looks like,
yes,
and they pay off their credit cards, don't touch them. just leave them there. They'll sit on your credit report for a very long time. Personally, when I went through this process, I had zero balance accounts on my credit report for 5 to 7 years, and they eventually just closed themselves out. But while they were there, they were giving me positive contributions to my score.
Right.
Definitely just leave them. I promise the companies will close them on their own.
For you. You're not being profitable for them.
Yes, absolutely. Absolutely.
Okay.
If you have like an auto loan and you pay that in full, or a home loan and you pay it in full, that will automatically close on its own. You don't have to go do anything or report it to the credit bureaus.
Okay, great. What's your next one?
So the next one is new credit. This is 10%. And this is where we want to talk a little bit about inquiries. So when you get new credit, it can hurt your score just a little bit, just depends on the type of credit that you're going for. But there's 2 types of inquiries that you can get on your credit report. One of them is a soft inquiry. So that's like if you pull your own credit report, it's a soft inquiry and it doesn't impact your credit score. But if a mortgage company, if a mortgage lender was to pull it, then that's a hard inquiry. That means that they're pulling it to see if they're going to give you this loan. Now, let's say you're looking for a home and you're checking out a few different banks. You're looking to see, what's the best financing I can get. If the inquiries are hard inquiries, but they're all for the same purpose and generally within the same time period, it will only count as one hard inquiry. Whereas, let's say in January, you decide you're going to buy a home, you find one that you like and you go to try to get the financing and they pull your credit report, but then something falls through with the sale. And then you say, okay, I'm just going to take a break. And in the spring, when inventory is up, I'm going to go try again. And you go back in the spring. Well, if enough time has passed, it will count as 2 inquiries. So I think that's important to understand that it's same thing with a car loan. If you're shopping for cars and your credit report is pulled 3 or 4 times in the same weekend that you're shopping, it's just going to be 1 inquiry. But if you shop for cars over the period of a year and it's pulled every couple of months, then it will count as multiple ones.
And with inquiries, we're talking about a couple of points, right, for each inquiry?
Yes, it's not significant. Again, it says it's 10% because you can have an impact if you get lots and lots of those hard inquiries. So for example, somebody that comes out of college and they're getting their first job, okay, but they don't have income yet. But a lot of folks are coming out of school and they want to get their own place. They want a whole new wardrobe for their new job.
Fabulous.
Yep. Maybe they need lots of services before they get ready for this new job. They're going to go and open up a bunch of credit cards. And that's going to be a bunch of hard inquiries. And in addition, they might be trying to get an apartment. So that's also a hard inquiry. So that's something to think about is, I know we don't walk into malls as much as we used to anymore, but if you walk into the mall and like store after store says, hey, if you open a credit card with us, you can get 10% off today. Well, just know that every time you do that day, that is a hard inquiry and it will bring your score down just a little bit.
Yeah, and just to your point, even though it's just a couple of points for each one, if you're already at a low threshold,
yes,
and then you just even have 1 or 2 inquiries, it could take you under that minimum credit score requirement. So be very careful with that. If you're looking at 800 and you have a couple of inquiries, you're probably not in danger of anything. But if you're at the lower end, you really have to be careful and mindful of every time that you're looking to have something pulled.
Yes, absolutely. Absolutely.
Okay. Is the next one the 5th one or the 4th one?
It is. It's the 5th one.
All right. What's that one?
Not that bad. And that's types of credit used. So again, this one's only 10% of your score because in a perfect world, nobody has any debt other than a mortgage and a car. But it does look at the mix of debt. So when you pull your credit report, you'll see different categories. So you'll see your mortgage in one category, auto loans in another, credit cards in another. So different debts are going to be broken into different categories. And the positive is having a mix of them, but again, a mix of them that you're handling well. because that all these factors are going to roll together. So if you have this really strong mix of types of credit and your payment history is good on them and you're not using all of the available balance and you're not opening a new account every couple of weeks, that's going to have a very positive impact on your score.
Excellent. What should one focus on if they want to increase their scores? The number one thing.
Well, the number one thing is making minimum payments. It really is.
That's the 35%. That's where the heaviest hit is, right?
Yes, it's 35% of the makeup. And that is, there's a couple of reasons why that's important. One, yes, the numbers, it's 35%, so it's the greatest contribution. The other is building the discipline and building the practice of building up your credit. It is the easiest way. It is the only one that you can wake up tomorrow and say, I'm going to fix this. I'm going to have a positive impact on my credit score. I'm going to set up automatic payments to pay the minimums on all my credit cards so that I don't have to worry about it. And that's really the only one of these that you can influence right this minute. So that's why I think that's the first thing they should do.
Okay. There are three major credit reporting agencies: Equifax, TransUnion, and Experian, right? Mm-hmm. Each of these are just companies who collect data, store data, and allow creditors to pull the credit from them. Yeah. We had a question from somebody that said, I pulled all of my credit, and we'll talk a little bit about that because we should be checking our credit scores and making sure that our credit data is correct. They pulled it, and two of them were virtually the same. The scores were virtually the same, and one of them was 100 points off, which is huge because I don't see credit reports as much anymore or hear about the credit scores as much anymore because I work more with sellers than buyers. But 100-point swing in a credit score is pretty significant. Can you talk to us about that? So when we're reviewing these, and are we allowed to, by law, to review these for free? So to talk to us a little bit about that.
Sure. So I'll start with how you get your credit report, because the credit scores, there's a lot of different ways you can get them now. There's free ways, there's paid for ways. I know a lot of folks use Credit Karma. That's a free way to get your score. And most people will notice a difference between all three of the bureaus. Usually that difference though is not off by more than 5 to 20 points. Mm-hmm. A couple of points. I've never seen it off by 100 as in that example. So that tells me that something could be wrong in the credit report, or it could just be a significant timing issue. So when those three companies you mentioned, when they run your score and run your report, they're doing it at different times. So it could be a timing issue that they might not have the information. So Experian might not get notice of a closed account as soon as TransUnion does. It might be a timing issue there. But with a significant difference like that, you want to dig into your credit report and see if there's any variances. See if an account is missing from one or the other, and that can be possible. Some lenders only report to one or two of the three companies. But this is where it's really important to have somebody to help you through this. Because if you've ran your credit report before, you know that it's like a hodgepodge of information. And for me, it's light reading for the evening, but for most people, it's just not.
It's light reading. I bet you're the type that enjoys homeowners association documents too.
Oh, that sounds fantastic. Send them.
That's a party at your house, huh?
Yes. Yeah. I won't even tell you what I read last night.
Emily, that's hilarious. Let me ask you though, you led me to another question is, how can CCCSMD, credit counseling, how can you help people to increase their credit score? So you talked a little bit about the service. What do you do that could help them to raise their credit score for $40?
Sure. So if you check out our website, we have really good information about our credit report review service. That's the one that I was mentioning. That's just $40 for an individual or $60 for a couple. And like you said, you get a lot for that money. Our financial advocates, they'll help you pull your credit report. They will go through that credit report with you to help you understand what's having any negative impacts They'll also show you the positives, of course, but we know we all want to focus on the negatives and improve those. So they'll help you, they'll help show you that, hey, you know, you're not making your payments on time every month. That's really pulling your score down. And then they'll turn around and say, let's create an action plan. And what are we going to do to fix that? And they'll help you, whether that's helping you create a budget to make sure you're making those minimum payments, helping you determine if there's other types of debt you need to mix it up to help with that 10% contribution of types of credit, and help you get a little bit of control on the new credit. If you are in a phase of life where you have been relying on debt to get by and you've been opening lots of lines of credit, they'll help you see that this isn't helping your credit score. We have to get this under control. So they'll sit down and take the time to go through the credit report, make the action plan, and then, you know, be there to assist you through that. So I really like that kind of service. Again, a lot of people pull these reports, and you can certainly pull them on your own, but having that person there to help you make sure you totally understand it, and not also make sure you don't waste time on areas that might not have that big of an impact.
Right.
So reminding you of the allocation and where you should focus your energy. Because we've talked to you, you can't do everything at once. You gotta focus it and take it in chunks.
Right. And what is the biggest impact? I think that's really, really important.
Yes.
And you mentioned earlier, Emily, that I want to come back to. You had mentioned earlier before we got on the call that during COVID, you're allowed to pull your credit report more than what the law says. The law says, federal law says, you're allowed to pull your credit report from each repository, from each credit bureau, once every 12 months.
Correct.
But during COVID, that's different. What is that about, Emily?
Yeah, that was really exciting. I know we shared a lot about that on social media when that first started, because we know how important it is for people to be educated on what's in their report. And there's a few reasons for that. But I'll tell you kind of the answer, and I'd like to go back to that. But annualcreditreport.com, if you go there, you can pull your credit report for free every 2 weeks during, and really it's until April 2021. So I don't know if that means they expect the pandemic to go that long. I don't want to think about it, but who cares? We'll take it. We'll take it. That's great. And there's a big reason for that. One of the reasons is that fraud is on the rise. Fraud is it's always a problem. It's increasingly becoming more and more of a problem as our technology advances. But right now, the scams that are out there and that are targeting certain groups of people, especially those that might be struggling financially, that could end up on your credit report. There could be things going on out there that you don't even realize you're signing up for. So, and there's, especially for older Americans, making sure that they understand that, hey, like if you sign up for this or you co-sign this for a grandchild, these are the things that are going to end up on your credit report. So they're encouraging you to review it as often as you want. And you know, every 2 weeks is certainly sufficient, but it's good to keep eyes and make sure that you recognize all of those accounts. I remember a couple of weeks back, I pulled my own. I do pull mine regularly. And there was an account on there that I didn't know. And it didn't have a balance, but it really struck me as a name I never heard of. And luckily, through some quick Googling, I realized that a company I used to have credit with had sold to another one.
Oh.
And the name had changed. But things like that are important to know, so that, you know, when you're asked, if you're applying for a mortgage and somebody says, hey, you know, what's going on here with this credit, you'll know what they're talking about. You won't be blindsided by anything.
Yeah, and such a good exercise to go through, just like you go through profit and loss, or you go through your budget. Just a good financial exercise to continue to look at your credit score, because you'd rather find that out the month that it happens rather than 11 months later when you're applying for credit and then have to investigate while you have the home of your dreams on the line.
Yes, absolutely.
Right? And the other thing, they don't want to find that out at that point. The other thing that I want to say to you is I have a situation where I have someone who I'm helping to get a lease, actually, to find a home to lease. And fantastic credit, fantastic job, credit worthiness is at 10 plus, very, very low risk. But if you look at her credit, she has a lot of credit that she co-signed for her kids.
Yeah.
She went from a very good risk to not a great risk simply because of the co-signing, because she doesn't have her own debt and she doesn't pay these bills. Her kids pay the bills. Right. So she doesn't pay anything. There's a zero requirement for her, but not through credit. Through credit, she's required to, you're going to count that debt against you, even though you're not paying it. So one of the options that we're exploring is, should she pay those off, everything off, to get her ratios back in line so that it looks on paper as though she is as great a risk as she really is. So that's one of the things that she's exploring now with her financial people is that the right way to go, to see if that would make more sense for her, rather than being rejected on homes or paying more as a result of what it looks like on paper. Interesting, right?
It's very interesting. And I personally, warn people about this a lot, especially family and having situations where folks do want co-signers. So there's a couple of ways she can handle that. She can do what she's talking about doing and getting it all paid off. The other thing is exploring refinancing, getting her off of that loan, having the children refinance to be on their own. That's another option.
Okay, good. I didn't even consider that.
Right. So that way it takes the pressure off of her to spend the cash right now, because she'll probably need that eventually for the housing expenses or a future down payment. And it also kind of pushes the kids into, hey, you gotta go do this.
Hey kids, it's your turn.
Yeah. Welcome to the real world.
Yeah.
My kids are 5 and 3 and I'm already telling them they need to go pay for their own home stuff.
I love that you're going to share your light reading with them.
I do. They have a script in their head. They know all about credit cards and how they can't have one.
That's excellent. I love that.
Yeah.
Do you have anything else for us, Emily, that you wanted to share that we didn't talk about?
I guess just a couple of things maybe. One is we talked about the services we offer for the credit report review. I encourage everyone to visit our website because we've done some blogs on that. We have a lot of information on the webpage about it, but we also offer a free webinar. And it's all about credit scores, credit reports, and that walks you through some of the things we've talked about today, but it also expands into other areas and it's just a deeper conversation. So I would encourage people to sign up for those. They happen fairly regularly, and through our website you can find our webinars, and it'll take you to Eventbrite where you can register, and those webinars are free. And lots of good information in there.
And what about your Facebook page? What is your page name?
Sure, it's just CCCSMD, and I think our handle is at CCCSMD 2019 right now. Got to change that.
Yeah, it's fine.
Working on it.
Yeah.
But
I think you guys are waiting just to jump right over 2020.
Right, we just
don't
want to do it. Well, we had a big campaign we were involved in during Protect Week in Maryland back in June. So we wanted to get through that because other folks were tagging us. So we were just waiting to cross that.
Yes.
Hump. So on our Facebook page, we try to share content that's relevant to folks that are looking to improve their score, improve their financial health. We share a lot of information just about keeping a lot about budgeting, a lot about making sure that you're financially healthy. And we promote calling our financial advocates quite a bit because, there's a lot of times that people say to me, I wish I had just called sooner. Mm-hmm. And some of the reasons people don't call, you kind of touched on, one is shame. You shouldn't feel any shame. This is just a game. Really, it's just a numbers game. It's not a personal game. It's not numbers against Diane. It's numbers just against the world. So there's math, and math can be manipulated, and we can help you fix math. That's all it is.
Love that.
Yeah, so that's what I would just encourage people to do, is check out our content, but don't hesitate to call. It's amazing how you just call and somebody picks up and is ready to help you. And
one thing that I love about what you guys do is that so much of it is for free. It's just education, and it's your company coming really from the heart to help people with their financial health. I love that because you're not selling something every 5 minutes.
No.
It's real education on getting someone from here to hear from where they are now to where they want to be. So I applaud you. I applaud your company. I applaud everything that you do, and certainly for your education and being on this call with us now for free. Right?
Yeah.
Right.
Yeah.
You're not making money right now. So I thank you for that. And just doing the right thing by people. It's an important thing.
We're very passionate about it. It makes us very happy to see people succeed, and not just see the numbers, but see how they feel, see that it really improves their lives holistically and not just their bank accounts.
Yep. Well, I appreciate that so much. Well, thanks everyone for tuning in. Emily, I appreciate you coming in for the second time, and I think that we have a couple more scheduled in the future, and we'll talk about the timeline for that. So I appreciate it. And everybody, if this is helpful to you, or you know people who are struggling or just trying to get a better understanding of credit, please share this video with them. We appreciate it. We appreciate you, and we'll see you next time. And here is the information that you'll need. And check out CCCSMD 2019 on Facebook. They have a ton of really good information. Thank you all, and we will talk to you soon.